Well, good afternoon, everyone. I want to just begin this final session with just a generous thank you to Larry Goodman and the Center for Financial Stability for their great partnership in helping to facilitate this great event today. It turns out that Fannie and Freddie, which is the topic, the GSEs, the government-sponsored enterprises, are a perfect topic that marry the partnership between our two organizations. The first is that, of course, the GCSEs brought a lot of financial instability events as part of the GSE balance sheet collapse that precipitated their continuing conservatorship. And of course, with regards to the Federal Reserve, their function of lender of last resort and their focus on financial stability, and of course, their continuing importance of GCSE securities in their balance sheet, make this combination of financial stability and monetary policy have a great intersection with regards to Fannie and Freddie Mac. I also want to say that historically, the Shadow Open Market Committee has had many presentations on their concerns about government-sponsored enterprises, of course, before the great financial crisis. Bill Poole, who was a long-serving member of the Shadow Open Market Committee, and while he was president of the St. Louis Fed, wrote a number of fundamental papers that demonstrated the inconsistencies of the balance sheet risk and the implicit guarantees of the securities from Fannie Mae and Freddie Mac. I took on that mantle when Alan Meltzer asked me to take over for Bill Poole in this area. In 2006, I wrote a paper for the SOMC entitled Housing, the Next Financial Crisis, which also pointed out what we thought were very inconsistent paths. Now, right since the great financial crisis, Fannie and Freddie have been reasonably quiet. But as you know, in the last several months, the topic of the government-sponsored enterprises is no longer quite anymore. And today, I can tell you, you're in for a treat because we have two exceptionally talented intellects and exceptionally talented academics here to talk about these important matters. Let me begin with the first speaker, Matt Richardson, who's a specialist in Fannie and Freddie and GSEs, and he is going to focus primarily on and tee up the background on Fannie and Freddie, and to also lead us into the kind of the building blocks of the conversation with regard to what's next and what are the proposals, what are the possibilities for what will happen to Fannie and Freddie going forward. And finally, after that will be Debbie Lucas. Debbie's a member of the Shadow Market Committee, an exceptional economist who focuses her work on the implications of very important policies and all their detailed connective tissues. She has a clinical, detailed understanding of both private and government financial issues. And from this, we will have a great conversation afterwards. I'm going to ask each speaker to go for about 15 minutes. I know there's always a little bit of a grace period. And then from there, we'll have an open conversation. I look forward to this great and wonderful presentations. Thank you.
Thank you, Greg. First, I'd like to thank the Center for Financial Stability and the Shadow Operating Market Committee for inviting me today. So I'm very much the opening act for Debbie. Just this is Wednesday, actually, a couple of days ago, my college graduated son, who's living with us, I dragged him out to Brooklyn Paramount to see Robert Plant of Led Zeppelin fame. And Robert Plant had an opening act, so I know my role. I know my role here. Okay, so at NYU Stern, we around the financial crisis, and subsequently through thinking about issues of financial stability, we've had many faculty involved in sort of, academic articles and also sort of policy type pieces. We ended up writing a number of books. And one of the books was on the GSEs called, aptly titled, Guaranteed to Fail. What are the GSEs? Well, I think we all know that. They really have had two functions leading into the crisis. One was the guarantee function, where they guarantee the credit risk of mortgages. And the second was an investment function where they invested in mortgage-backed securities. It was about $3.5 trillion at the time of the global financial crisis, and 1.7 on the investment side, so a big footprint. And as we know, they had pretty strong implicit/explicit guarantees. What I'm going to do in the next 10, 15 minutes is kind of lay out, what happened. They were private sector institutions with a lot of government backing prior to the financial crisis. So I'm going to talk about kind of what they look like and some of the issues that we learned during that process, and the conservatorship, and then subsequently, what's happened in the conservatorship briefly about the kind of things they've done to address some of those issues. And then we'll talk very briefly about what's coming, and then I think Debbie's going to talk a lot about the implementation of it. Right now, just as a side note, they have 7.5 trillion guarantees, so they haven't gotten smaller. They've gotten 50% bigger. They do have a much smaller investment portfolio. That's through restrictions placed on them, within the conservatorship. They have about 300 billion. One thing we did in the book was we looked for quotes pre-crisis, and we kind of started every chapter with a quote to try to represent sort of some of the thinking that we had about what was going on. And so here is one quote about essentially the GSEs play a double game. They tell Congress, hey, don't worry, you're not on the hook. And then the next day they go to Wall Street and say, by the way, the government is on the hook. And that is sort of the idea behind this implicit guarantee and the sort of private investment. That was by Richard Cornell, who was the Assistant Secretary of State in Treasury. My favorite quote, though, is actually from David Frum. David Frum was a speechwriter during the Bush administration, and later like a commentator, and I think he was an editor of some magazines. So the quote goes, "The shapers of the American mortgage finance system hope to achieve the security of government ownership, the integrity of local banking, and the ingenuity of Wall Street. And instead, they got the ingenuity of government, the security of local banking, and the integrity of Wall Street." So, and I know it's a funny quote, but I think it does capture, some of the issues that we face. What happened was, we know very rapidly, starting in 2000, the GSEs started securitizing and guaranteeing the credit risk of mortgages in kind of a large way, creating almost a 40% share of the mortgage market was securitized. As I mentioned, it's 7.5 trillion now, and actually 74% of the mortgage market. So it has increased tremendously in conservatorship. There are two issues. Some people would argue that it's from the liquidity in the market, which is to some extent, but there are two sort of things that are like hanging out there during that period. And one was sort of the underpricing of the government guarantees. So they were priced with not much variation across risk, across mortgages, and not actually much variation through time, about 20 basis points, 22 actually when they went down, in terms of their credit risk. If Geico or Chubb offers insurance, all of a sudden the policy is half price, we buy a lot of it. So that's not surprising that we did that too pre-financial crisis. Now the G fee is actually quite somewhat higher. It's about 50 basis points, and importantly, and as a positive, it does vary cross-sectionally across risk in the mortgage-backed security sector. So that they did fix a little bit. It's still, to the best estimates, and there's a variety of estimates, it's still probably underpriced by about 15 to 25 basis points. The second issue that was pre-crisis was regulatory capital arbitrage. And this is very much the David Frum's quote, I guess. So banks, in terms of conforming mortgages, they hold the whole mortgage on their books. They're charged a 50% risk-weighted assets, so it goes from 8 to 4%. If that mortgages are then sold off to the GSEs, and the GSEs package the exact same mortgages and sell them, and the bank puts them back on their books, so the identical mortgages, identical assets, but with the GSE backing, they only had to hold a 20% weight, which was 1.6%, but the GSEs only had to hold 45 basis points. So the capital requirement went from 4% down to 2% for the exact same assets, same risk. So we can debate about, what's the right amount of capital you should hold, but I don't think we would debate that there should be different systems. They should be consistent with each other. To the credit, again, of in the conservatorship, there's a minimum requirement now of 2.5%, which actually gets them onto kind of equal footing. Of course, the worry would be, when they're private institutions again, with the government backing, you can imagine there might be quite heavy lobbying to lower the capital requirement or to lower the G fees. This looks like a complicated chart, so I don't want to spend over the time. Don't spend too much time on it. But look at the little red dash lines and the black dash lines. The black dash lines is the increase in non-GSE securitization, private label securitization, leading into the financial crisis, and the red line is the GSEs securitization. And what you kind of notice is the GSE started losing market share, and the private label started gaining market share, and then all of a sudden it reversed 2 years going in. We called it a race to the bottom because when you have two entities, these large complex financial institutions with implicit too big to fail guarantees, and you have the GSEs with the implicit backing of the government, that's a lot of moral hazard in the system, and they definitely played it out. This is from a secret strategic plan that got released during the investigation from Fannie Mae. And you can see it's like our business model, investing in and guaranteeing home mortgages, is a good one. So good that others want to take us out. Under a new strategy, we're going to take and manage more credit risks. That's what they did. They put on a lot more risk on their books. In the book, we said, imagine you're in Tokyo and you had King Kong, let's call the GSEs, and Godzilla, let's call the large complex financial institutions, battling it out. And of course, Tokyo was being destroyed in the midst, if you want to think of that as a financial system. And what's happened since? There has been tighter regulation on the LCFIs through Dodd-Frank. So perhaps this is not relevant for a current framework, but it is relevant that when you go into a financial system and you regulate an entity, you're part of that whole system. So there's relative pricing across that system. So you have to think of it in whole, not individually. So I think that is relevant. What happened? We know from 1995 to 2006, house prices in the aggregate went up on a straight 135-month in a row platform. Then there was that big decline. You can see it circled there. And, it's just a theorem almost that if you have a big fall in the asset, and the asset has a fair amount of credit attached to it, you will get defaults, and that's what you got. So, you would have testimony from the executives of the GSE saying we manage credit risk really well, and we have very little credit losses as we currently do. But of course, that's because we haven't gone through a big house price decline. It's a very asymmetric shock that occurs in that marketplace. Just to give you an idea of sort of the crazy town, the GSE's investment, they grew dramatically during that period. They could fund them almost at the treasury rate, so just a little bit above the treasury rate. They were about 40 basis points below market rates for the kind of level of risk. they had leverage of 25 to 1, and if you included guarantees, that's 70 to 1. So I teach a course on alternative investments, and so it's basically hedge fund strategies. So I've seen a lot of the leverage that hedge funds have with the prime brokers. And those numbers, you only see it with relative value, long, short, equity, market neutral, and every sort of aggregate thing. Here, you're exposed to credit risk and interest rate risk. So now, of course, as I said, they have restricted the portfolio size, but nevertheless, that is something to think about. Okay, 5 minutes. Okay, so the problem. So the argument for why it should be still a public utility and still being debated is that if there's a problem with the GSEs, the government's going to have to bail it out. So in bad times, the taxpayers bear the costs. So in good times, they should earn the profits. So that's sort of the argument. Of course, there are problems. No market pricing, so it's fine for the regulator to figure out what the G fees might be, but of course the market prices those things much better. And we don't have that except for the credit risk transfer system, which has worked okay. We need the market pricing. We've crowded out private markets for sure, like if we've gone from 2 trillion to 5 trillion, now to 7.5 trillion. That is crowding it out. And again, we've got the governance. Generally we think of government institutions as probably not being well governed, and there is a lot of political capture. Our mayor, we're about to enter into the grocery business, maybe in New York City. My college son, who I went with to see Robert Plant with, tells me that I don't understand the plan. So it's true. I did tell him about the 7 trillion, and he did think that was a little bit too much, though. On the private entity side, the GSEs, we have a banking sector that knows how to do mortgage lending. They do corporate lending, credit card lending. We price risky corporate loans. We price risky bonds. Why not mortgage bonds? We know how to structure finance. We have structured finance. So it seems that to reduce the distortions in the marketplace, market pricing of guarantees for financing costs would sort of be the better system. That's the argument. The two negatives, the two problems potentially are the insurance business is a business where you take, diversifiable risks that have catastrophic consequences for the individuals taking it out, whether it's individuals who are taking out car insurance or house insurance, or corporations with property casualty, hurricane insurance, et cetera. Those are all diversifiable. The required return, loosely speaking, is around the risk-free rate on those activities, because you've gotten rid of, through diversification, have gotten rid of all the variance. Mortgage insurance doesn't do that. It protects against non-diversifiable risk. That requires a risk premium, and unfortunately, it requires large capital reserves for the bad state, right? So that's the issue. Systemic risk is a problem in the financial system. We don't operate in a free market. We have deposit insurance, as Charlie Calmiras talked about. We have too big to fail. Alongside, we're trying to regulate at the same time. So it's hard to sort of think about it without systemic risk being part of that system. So the quandary, you've got nationalization, the benefit, maybe the guarantees of mortgages, increase liquidity in the mortgage market, lower the liquidity premium, get better pricing. Against the difficulty in pricing the guarantees and the lack of market discipline, which of course is due to kind of moral hazard and excess risk taking. So, another great quote we had in the book: once one agrees to share a canoe with a bear, it's hard to get them out without obtaining his agreement or getting wet. So that is the issue. We're trying to basically get the bear out of the canoe. How do we solve it? We called it the genie in the bottle problem. You know, you got to put the genie back in the bottle. And so, you want a private system for that to happen. You really can't crowd out private markets because that's going to give you the fair pricing. You want to avoid this kind of regular capital arbitrage. You want everyone to be kind of on an equal footing. And you do have to manage the systemic risk. There were many proposals post-financial crisis. And I've mentioned a few of them here, both inside and outside the government. Corker Warner, Johnson Crapo, Campbell Peters, many of them. There's a lot of activity. Not much since that. And we even had our own thing. We sort of viewed a world like there was two phases. The first phase, you would have a private-public partnership where the private sector would price the guarantees, and then the public sector would provide, as a silent partner, the capital, and then they would collect the fees and just pay out of a rainy day fund their portion. And then over time, you would just gradually reduce the conforming mortgage limit until you kind of got rid of the need for guarantees in the system. Obviously, that didn't happen. So the last 15 years, other than against credit risk transfer, and I would, there has been better regulation of the GSEs that we talked about with the G fees and the capital requirements. We have not been really transitioning to, this kind of private mortgage finance system. Charlie Calamiris kind of mentioned it in his talk. The discussion, the focus really seems to be ending the conservatorship, which I'm sympathetic to, and taking them public, albeit though with the government guarantees. And so that's going to require a lot of regulation. Government's sitting at the top of the capital structure, and they go public, they're going to have to restructure, and that's going to lead to a divvying up of the assets of the firm, and I think that's my lead into Debbie.
Okay, great. I want to add my thanks. This has been a really great meeting, and just going to jump right in. So, Mike, I'm going to talk a lot about what has come up in this administration, which is the possibility of recap and release of Fannie Mae and Freddie Mac to the private sector. That is something, as Matt said, there were lots of proposals to try to move them forward that never went anywhere, and now it seems like it could actually happen. So I want to really get into the question of what might happen, and I'm just trying to make this, okay, there we go. Okay, so I'm actually going to skip this slide because Matt gave great background, except to say that sometimes when there's this issue of has the government been paid back or not for the bailout, I mean, it's kind of it's not talked about in a very clear way. But if you looked at the cost as of the bailout, taking into account that things could have gotten worse as well as gotten better, and they did get better, a forward-looking estimate was about a $300 billion bailout. So, it's really a lot of money. It was, I think the largest single bailout of the financial crisis. So let me just go on. Oops, sorry, wrong way. So let's just first talk about whether reprivatization is a good idea. And this is kind of a list of pros and cons. I think the biggest pro is that you bring the private sector back into the biggest part of our capital market, the mortgage market. So the private sector has insights on the pricing of risk and return and the price of guarantee fees and all. So what do you get from that? Well, fundamentally, in real terms, you'll get more efficient allocation of capital to the housing market because the pricing will be better. And also, I think very importantly, and Matt kind of alluded to this, the market needs information about buildups of risk. And if you can't see a real price of mortgage risk in the conforming mortgage market, you don't really get those early signals. I know some people want to look at the CRT market as a way of getting that information. I've written about that a bit, and I've concluded it's for various reasons, it doesn't give you a very clear price signal. So you get that. I think also very importantly, and I think this didn't come up in what Matt said, having the GSEs in direct federal control is really a cookie jar for the government and every special interest in housing finance from across the political spectrum. I mean, it's one of those issues where I don't want to blame the left or the right. It's just like everyone has their hands in the cookie jar, and it's not budgetary. I mean, I think if there's the will to subsidize housing, so be it, but it creates a lot of subsidies that are off budget. They're not controlled, they're not recognized. So I think it will, I think there will, I should say that they will still have the GSE charter and they will have some government advantages, and for sure they'll still be regulated. They'll still be under the Federal Housing Finance Administration. So they're not going to be non-federal, but at least it would be a step back from direct federal control. And then the last thing is also very important, this incentive for greater product innovation. So if you think about why do we have the GSEs in the first place, well, it's because we have a 30-year mortgage, and that's really unique in the world. I always describe them when I'm teaching my classes. I say that's a toxic financial derivative. Why is it a toxic financial derivative? You have a 30-year nominal obligation, which is prepayable with no penalty. So there is this idea that I think is pretty widely accepted that market wouldn't necessarily be sustained without significant government backing, and that's why we have all these institutions that are quite different than the rest of the world. So be it. It's the way things are, and we want, I don't know about we, but many people want the status quo to more or less continue. So we will still keep having these institutions, but if they are privatized, then perhaps there'll be some forces, some product innovations, and that will maybe shorten the maturity of mortgages and so forth and make it more stable. So on the con side, obviously, if you just release them back into the market, you're recreating the sins of the past, potentially, monopoly or duopoly power. They will still have some advantages like access to the TBA market that will put them in a very strong competitive position. This could cause mortgage rates to rise, which is a big concern by opponents of privatizing them. We've already talked at length about the fact that the government would still be on the hook. In fact, legally, under the legislation HERA that brought them into conservatorship, there still is something like $113 billion of budget authority to continue to support them. That's all that's legally now explicitly there, but presumably there'd also be an implicit guarantee again. And then finally, there's the thing I'm going to focus on in these few minutes I have, which may seem like the most minor point, but at least it's something I think we can do something about, is that in the process of privatizing them, there's a considerable risk that there'll be a significant wealth transfer from taxpayers or the government to investors because the IPO is poorly designed. So I know it's late in the day to be talking about this, but I'm still going to attempt to do it. So why should we worry about the wealth transfer? I should start out by saying, well, it's potentially tens of billions of dollars going one way or the other. So it's actually real money. This could all happen with people really not understanding it very well. Why? Well, first of all, the government's current legal claim to the GSEs is really complicated. So let me just leave it at that. It's complicated. I'm going to try to explain it to you as simply as I can. The next point, I think, is incredibly important in a world where the whole world is moving back to a love affair with industrial policy, and certainly asset sales are something that governments are trying to do to raise money in times of fiscal stress. So one thing that is quite unfortunate about government accounting is that you, the government, can look like you're making a lot of money from an asset sale when in fact, from an economic perspective, you're losing money. Why is that? Because the government accounts recognize the money that comes in from the sale as revenues, but the accounting does not recognize the loss of the value of the thing that you own. So, imagine that the GSEs are worth 100 billion and you sell them for 80 billion. You count that as a gain of 80 billion, not a loss of 20 billion. So, the accounting can allow you to kind of give them away without really reflecting it in the accounting. So that's a problem not just for the GSEs, but for many things. And then, well, we live in the world we live in. So I talked about the various interests in the housing world, but beyond that now, there's the former shareholders, both common and preferred, of Fannie and Freddie, believe that would like to get their money, and they may have some friends in the current administration. So, there's a lot of forces moving in the interest of let's just get the deal done, and let's not worry too much about the cost. But I guess I want to worry about the cost, and I'd like to get you all to worry about the cost. So just as far as what the existing shareholders, after the financial crisis, those are plots over time of the share price of Fannie Mae and Freddie Mac. So basically, they were pulled into conservatorship because they were bankrupt. The government keeps them going, but their stock essentially goes to zero. But what has happened recently is the stock price has crept back up of both Fannie and Freddie, with the prospect that an IPO would put some wealth back in the hands of the original shareholders. Excuse the slide. I don't know why the stuff on the right is there. It's for me, not for you. So the right side is just the current balance sheet of Fannie Mae. And then the left-hand side, which is what I want to talk to you about, is for Fannie Mae, what their book value equity piece of their balance sheet looks like and kind of what it means. So let me just start out by saying that so Fannie Mae has total book equity of about $101 billion. And then there's a bunch of claimants to the value. At the top of the stack is the federal government. They have the senior preferred stock. That senior preferred stock represents all the money that the government paid into them over time in order to keep their capital from going negative. Okay, so that's the cumulative amount that was paid in without any interest or anything. Now, why do I have two entries for that? Well, there's two entries. The first number represents what they paid in up until the time when they recently changed the rules. So what they wanted to do is, in preparation for thinking about maybe we'll privatize them and they need to accumulate some cash, the dividends that used to be swept out into the government now stay on their balance sheets. So that senior preferred with liquidation preference reflects what they paid in and then what they would have received as dividends, but now is sitting on the balance sheet of Fannie and Freddie. So there's two different numbers. And the reason these two numbers matter is because there's two possible rules for privatization, one based on the first number, one on the second number, and it makes a big difference in what the value is that the government is going to get out of the whole transaction. Okay, so there's the senior preferred stock. Below that, there's the old investors who had some preferred stock of about 19 billion. And then there were the common shareholders, which were the people I showed you on the graph before. Lots of common stock basically went to zero, now has some value. So I guess the key takeaway from this book value picture of the GSEs is that just on a book value basis, the government's claim is so much bigger than their book equity that it should be kind of irrelevant. The government just owns 100% on a book value basis. But that's not the whole story, because in fact, as in many companies and many financial institutions, there's a big gap between book and market value, because the book value is kind of backward looking. The market value is going to reflect the future business, the value of their existing guarantees in excess of their existing default liabilities and so forth. So in the interest of time, I'm just going to say there's lots of ways of trying to estimate what their true equity value is. My own back of the envelope calculation gets me to about 385 billion for the combined GSEs, but I'm going to stick to Fannie, which is 227. I'm sorry for so many numbers late in the day, but let's just imagine that Fannie Mae is worth 227. I'll say that that's pretty consistent with what the US government reports in their financial statements, what CBO has done a bunch of calculations recently. Some of the administration estimates are considerably bigger, closer to 600 billion for the combined entities. Probably an exaggeration, but in any case, this, that's kind of a reasonable number. And in fact, we can't know what they're worth, and it's really important to understand that what they're worth is very much going to be a function of what the regulatory policies turn out to be. So if the government gives them a very strong guarantee and requires very little capital, investors are going to pay more, which is in fact another incentive for the government to do less before the IPO, ironically. Okay, so here's the challenge for the IPO. You want to raise enough equity to meet your capital requirements. Let me say a few words about the capital requirements. Just, in fact, Matt was right. Their capital requirements used to be laughably small, but the current capital requirements under their regulator look very much like bank capital requirements. So they're up to about a 4% capital requirement. So when they're thinking about what they need to put aside, it no longer seems unreasonable. Also, they are a lot less risky than they used to be in the sense that they're only taking on credit risk and not taking on prepayment risk to the same extent. But in any case, that's their capital requirement. While I'm here, though, I also want to say that to me, this is a bit of a red herring because when I look back at their value, like for Fannie Mae, if they are worth upward of 200 billion, their current capital requirement is 185 billion. So in some sense, they already have the equity to meet it. But in any case, okay, they want to IPO, they want to attract new investors, but how can they attract new investors when the government has this preferred senior claim? Because the problem is, as soon as a new investor came in, effectively their money could be transferred to those more senior claimants, both the private and the government's preferred. So there's a problem with how do you kind of structure this thing so that new investors are willing to come in without being diluted. And then finally, there is the need for price discovery. Since there isn't currently a market price, it's hard to figure out exactly how this is all going to work because we don't have market price signals. And so we want the IPO to actually give us price discovery. Okay. I know that you're probably blanching it. I only have 2 minutes or something. Okay. This is, if you still have the energy for this, it's kind of instructive. I'm looking at 3 cases here, this is for Fannie, and starting out with my 227 billion of total equity value. So the question is, how much is the government going to get? How much are the old preferred shareholders going to get? And how much are the old common shareholders going to get? And these are calculations that are just really taking that legal waterfall of who gets what, under the assumption that we all agree that there's 227 billion to divide up, and it's asking what happens if the government goes on the rules where I kind of blew it before. I didn't completely explain the value of what the government has, but I'm going to do it here. Okay, the case without liquidation preference is that the government gets its entire $121 billion, because there's enough money to cover that. And the old preferred stock investors also get their 19 billion. And now what's left is 87 billion. What I failed to explain before is that that doesn't go straight to the common shareholders because, in fact, the government has warrants that give them 80% of that. So the government both has the senior preferred position and they have an 80% claim on the common. So the bottom line is that if they go without the liquidation preference, their position is worth 190. I told you earlier there's this liquidation preference, which basically gives them back all the money that went onto the balance sheet that would have been paid to them as dividends. So if they have priority on that money and you go through the algebra, the government comes up about $30 billion ahead, because then they come out at 219.8. Now, I'll say that the market, the investors on the other side of this, do not like the liquidation preference, and they're trying to make sure that they don't get liquidated and resolved this way. I actually hope they do, because it gives them the most money. But even worse, there's a lot of pressure, I think, to say, oh, government, just write down your preferred shares to common shares, and then we can issue new shares, and then everyone will be happy. But if that's what happens, well, some people will be happy, because in that case, the government claim is only worth 166 billion. It's worth considerably less. And the existing common shareholders, instead of getting nothing or next to nothing, wind up with about $42 billion. So there's a lot of money at stake, depending on what the government chooses to do. Now, I'm just going to say one more thing, which is, so here on this example, I mean, the math was right, but it assumed we knew the 227. And so the question is, what if we don't know the value? I spent a lot of time thinking about this, because I really wanted to figure out a way that the government could preserve the priority of their claim and still deal with this problem that you needed price discovery now, and you need the government to write their shares down to common, but you don't want them to write it down to common without compensation. You want to make sure they have compensation. So all I'm going to say is there is a way to do it, and it involves the government writing down their shares to common stock, and also having a small IPO, which is a way of getting at price discovery. So the IPO is meant to just figure out what the market does think they're worth, issue a certain amount of shares, and then once you have that IPO price, there's a formula that kind of goes back to the example I showed you before, which shows how many of the government's shares they get to keep, how many go to the old preferred, how many go to the old common, depending on the outcome of the IPO and the price. So the math all works that way, and it preserves the priority of the government's claim. So I'm hoping someone sees this and says, well, in fact, there is a feasible way that the government could defend the value of their claim, so that we, the taxpayers, aren't subsidizing. The last thing I'm going to say is, I know Matt was kind of arguing, I never thought, by the way, I should have put my cards on the table. I am totally in favor of privatizing them, and I never thought those words would come out of my mouth, because I've just been a long-time critic, and it kind of reminds me of how I felt about Obamacare. This seems like a really big aside, but there were really good ideas for managed competition, which is kind of the heart of the healthcare reform, which was trying to bring competitive forces into healthcare and give everyone minimum coverage and everything. And Obamacare had to be like the worst manifestation of those ideas. But in the end, at least it got everyone healthcare coverage. How I feel about Fannie and Freddie is this is so much worse than the proposals that Matt was talking about, which really would have created some competition in the market and done all kinds of good things. But it's been so hard to pull them out of government control that I'd kind of rather see them released, and then we can worry again about restoring competition to the market. So thank you very much.
Well, thank you very much. I know that Fannie and Freddie are going to continue to be in the news, and I think we now have better appreciation for some of the building blocks that that will be part of the knife fight about how the rules are written, about how this all plays out. Does anybody have any initial questions? Anybody want to start off? Hey, you want to start? Oh, we'll go over here, please. Yeah, that's where the mic is. Please.
Hi, once again, Douglas Carr. Debbie, it's Rube Goldberg, finance. But what about just recognizing that the government guarantees they're like a sunk cost, they're a sunk obligation. Just leave them on the government balance sheet. Spin off a new company that is paid to service the obligations, and let the market finance the new company. So then you've got your price discovery. Your brow is furrowed. You got Oldco, which gets merged into, or old assets, merged into the federal government because we're already responsible. Newco is a brand new company that goes out and does new mortgage financings.
When I was talking about price discovery, it was just in order to privatize the GSEs. There's another kind of pricing that's essential for there being an ongoing organization, which is the freedom to set the G fees in the private sector rather than to have the government, the guarantee fees, what gets charged to people. And that would be the case if they were reprivatized. So I feel like this would get to exactly where you want to be, in the sense that after this all happened, they would be a private company. There would be market forces. The only problem is they would have a government, they would have maybe an implicit guarantee that might or might not be charged for. But if you don't mind that they get the free guarantee, then we're already there. And then but the other problem is it's really hard for competitors to come in because they still have the benefits of the GSE charters. And particularly the TBA market is a huge deal that we could talk about privately.
Can I just say, the
Follow
point
up.
is, if you have Newco, it's not a guaranteed entity any longer. You've absorbed the past guarantees because you're stuck with them. And you start a brand new company, new financing, they'd have a very sound, clean balance sheet, and they can go into the mortgage finance business without the government guarantee.
Well, possibly.
No, please. Yes.
Thank you, Niso Abu of Pace University and Ramirez and Company. If we look at the granular aspects of what the GSEs do, at the end of the day, they are short two options. The first option being an option on prepayment, which the borrowers pay for it in their spread. And the second option is a credit default option, in the sense that the qualifying mortgages are backed by their backstop. So the real question is, are those options properly priced? The first question, and then is the risk properly managed? There's a very well-developed market on Wall Street that trades mortgage-backed securities. And also, if we look at a country like Germany versus us, the existence of a 30-year mortgage market, and associatedly a very well-developed real estate market, has significant social welfare benefits.
Who wants to take that one first? Debbie, Matt, please. Matt? Very close.
Hello? Okay. Wow, that is close. So, no, for sure. Look, the BlackRock, PIMCO, Fidelity, add more firms know how to price mortgage risk. So I don't disagree with that. I think the issue is that it's a $7 trillion right now market with government guarantees. And the question is, if a company like the Newco or some other companies come along and provide these guarantees, do they get the implicit backing from the government? This is how do you get the burr out of the canoe? I mean, that's the issue, and that's the issue that they faced pre-crisis. And the whole point was to try and get out of a system that needed the guarantees for the mortgage market to operate. Unfortunately, we haven't done that yet. So I think I'll speak for Debbie, but I think Debbie's view is, let's just get them out and then maybe start dealing with that issue.
I mean, I'll just say one more thing, which is the imperative to get them out. If you look at current G fee pricing, there are private market signals. There's this credit risk transfer market, but if you look at the history of G fees and the implied risk pricing of the CRT market, the correlation is 0.2. I know this, there's like the GSEs, as long as they're in the government, aren't using the market definitely knows how to price these things. I mean, there's a jumbo market, so there's all kinds of comparable prices. It's just that as long as a government agency controls the majority of the U.S. mortgage market, we don't have a capitalist market in mortgage risk pricing.
If I could say one thing, like we know that it's underpriced because there are mortgages that are private label that look pretty similar to the ones in that the GSEs guarantee, but just don't quite conform. And there's quite a bit of difference. So that's how. So there's no doubt that there's underpricing.
Please. Yes.
Hi, I'm Peter Flokus with CFS. I'm one of the trustees. And first of all, thank you for being here. To go back to the IPO discussion, which I find fascinating, really. My question, which maybe is a little bit out of left field, and I apologize if there's an obvious answer to this and I'm unaware of it, but if there were to be an IPO, is it contemplated that one of the big banks, Morgan Stanley, Goldman Sachs, whoever it may be, JP Morgan, would underwrite it? And if so, have they given any input into any of these questions? Because I've worked on enough transactions, or at least seen enough that although they can certainly make mistakes, the big bank underwriters in pricing IPOs, and they have, some of them, infamous, generally they're pretty good at valuations, and they're generally at least adequately incentivized to try and get the price right, or at least right enough so that they don't look terrible the day after the IPO when the price drops 30%. And one of the areas that underwriters, as I'm sure many people here know, are good at is taking firms that, for example, had years of venture capital financing where you've got multiple layers of preferred stock with all sorts of crazy terms and sort of unwinding all of that. So I'm just curious as to whether any of the big banks have expressed any kind of useful level of opinion as to how they might go about doing the valuation and the underwriting, these sorts of issues that you've raised.
Yeah.
Thank you.
Sure. So we should have asked Mike while he was here, but my understanding is that the administration is talking to all the big banks about this. They're saying it would be the largest IPO in history. It would be much larger than Aramco, the Saudi oil company. What I'm actually proposing is that would be a big mistake for the government, and a kind of a subtle issue. I mean, in the sense that they can do a small IPO to determine the price, and then the government could slowly sell their share. If they wanted to do a really big IPO, there would have to be some discounting in the price. And since there's no urgency in selling it, why sell? Why have the biggest IPO in history for no reason? And it would just lose the government money. So, but I mean, I know they are. I mean, the banks are salivating over this, obviously.
Do you want to follow up there? I mean, the last proposal I heard was that they were going to float 5%.
Okay.
That's the last thing I heard.
Which is still a lot.
Still a lot.
Still huge.
Yeah.
Yeah.
I find the idea of a, and this isn't really my hard area of expertise, but I know a little bit about it. And I find the idea of doing a smaller offering as kind of price discovery, as you, I think, very aptly put it, intriguing. I just don't know enough about the markets, and this is like what I'd love to hear from Goldman's capital markets people, is that how reliable of a test is that? Because we all know that selling 10 shares into the market is a lot different than selling 1 million shares into the market, and but I just don't know the answer to that one way or another, and I'm curious as to whether there's been any thinking about how reliable that kind of test would be.
And I think one of the biggest issues with the valuation is really the post IPO regulation of, because the government guarantee is a big piece. It's a moral hazard, government guarantee, a big piece of it. So there's quite a bit of uncertainty. That's whatever you're doing, you're making a bet on that, unless they lay it out carefully beforehand. And the banks might be saying, we need to tell investors the parameters of what you're thinking in terms of sort of, there's been loose terms that they're going to be guaranteed, but have details for the investors.
I mean, speaking about the guarantee, I wouldn't assume that the government isn't going to charge them for a continuing guarantee, because I know, the CBO has released a few papers recently on this prospect, and because the government did bail them out, they can no longer say you can't score this because it never happened, because it did happen. So you could imagine it might be underpriced. It might be like deposit insurance, where it's they charge them 3 basis points, but it should be 6 basis points or something. But so that it'll also depend on whether there's some what the terms are.
And with that, we hit our mark off by a minute. Last final question was what? Andy, did you have last one? I'm happy to take it. Okay, all right. So I think we've hit our final mark. I will just give just a general thank you for everyone who's been here. The Shadow Market Committee has been around for 50 years. This is +1 with the Center for Financial Stability. We look forward to this great partnership, and thank you so much for sharing your day with us and learning so much about important policies that affect the prosperity of our country. Thank you very much.